Most Americans remember that date because of the images, the tanks, the missile strikes, the refugee families at border crossings in the dark. But I want to talk about something else that happened the same day, something that received almost no coverage. On February 24th, 2022, the United States Treasury and its allies deployed the most comprehensive financial weapons package in the history of modern sanctions. Swift access, cutoff. $300 billion in Russian central bank reserves, frozen. Technology exports, banned. Energy imports, restricted. Western corporations, ordered to exit. The ruble was projected to collapse within weeks. Economists said Russia's GDP would contract by 15%, 20%, some said more. One prominent analyst said Russia's economy would be reduced to the level of a failed state within 6 months. The plan was clear: break Russia economically. Demonstrate once and for all the absolute supremacy of the dollar as both currency and weapon. Show every country on earth what happens when you challenge the Western financial order. I want you to hear what I am about to say very carefully, because the next sentence is not an opinion. It is the most documented financial fact of the past 3 years. Russia's economy contracted 2.1% in 2022. Then it grew 3.6% in 2023 and expanded further in 2024. The ruble stabilized. Russian oil exports continued. Russia did not collapse. Russia adapted. And in adapting, without winning, without defeating the sanctions, Russia did something far more consequential than winning. Russia survived. Dollar weaponization has a limit. I'm your host. This is the Stat Guy. Let's follow the money. The dollar's power as a sanctions weapon rested on one assumption: that there is no alternative. That if America cuts you off from SWIFT, from dollar clearing, you cannot function in the global economy. That assumption powered 4 decades of American foreign policy. Iraq, Iran, Venezuela, North Korea, Syria. Every country that found itself on the wrong side of American foreign policy discovered the same thing. The dollar weapon is absolute because there is no substitute. Russia stress-tested that assumption under maximum pressure, and the assumption failed. China settled Russian oil in yuan, not dollars, yuan. And every barrel of Russian oil purchased by China in yuan was a barrel that did not create demand for dollars. India settled Russian oil in rupees, running a rupee surplus so large that India and Russia are now negotiating which Indian goods Russia will accept as balance. The UAE became a re-export hub, processing Russian goods and rerouting them to global markets. Turkey increased trade with Russia by 87% in 2022 alone. The alternative financial plumbing, CIPS, bilateral swap lines, yuan oil futures, that China had been quietly building for a decade, suddenly had a live use case, and it worked. Now ask yourself, what lesson did every other country draw from watching Russia survive maximum pressure dollar sanctions? Every government that has ever worried about being on the wrong side of American foreign policy, which is most governments, watched Russia absorb the most aggressive dollar weaponization in history and continue functioning. The conclusion is not that they should confront the United States. The conclusion is that they should quietly build the same alternative plumbing Russia used. Bilateral currency agreements, yuan reserves alongside dollar reserves, insurance. That quiet, distributed de-dollarization is already happening. It does not make headlines because no individual transaction is large enough to matter, but the aggregate, the slow, steady shift, is what the silver market has been pricing in for the past year. Silver at $75 today, up from $31 a year ago. That is not a war trade. War trades reverse when ceasefires happen. The Iran-US ceasefire 2 weeks ago briefly dipped silver, and it bounced right back. Because what silver is pricing is not the war. It is the structural lesson the war taught. In a healthy petrodollar system, where global dollar demand is structurally elevated because every nation needs dollars to buy energy, the dollar remains strong. And when the dollar is strong, silver's dollar price is suppressed. Silver was $5 in 2003, under $9 in 2008, $15 in 2016. In each period, the dollar's structural strength, maintained by petrodollar recycling, was holding the dollar's purchasing power artificially elevated, and therefore holding silver's dollar price artificially depressed. Remove that artificial demand, even gradually, even partially, and the suppression lifts. Russia's survival proved alternative systems can function, and that proof accelerated every de-dollarization trend already in motion. Every yuan oil settlement since 2022 is one less source of artificial dollar demand, one less contribution to the structural dollar strength that suppresses silver. And this is why silver's 142% move over the past 12 months is not the end of the story. It is the beginning of the market pricing and what has changed. Silver hit a nominal all-time high of $121 in January 2026. Then it pulled back 37% to approximately $75. If you bought near the top, I'm talking to you specifically. A 37% pullback in a structural bull market is not a refutation of the thesis. In 2011, silver fell 47% from $49 to $26 over 5 months, before the next structural leg. What is not corrected is the structural data. The Russia lesson is still documented. The de-dollarization data is still advancing. The COMEX registered silver inventory stands at approximately 76 million ounces against open interest of 576 million ounces, a coverage ratio of 13.4%. The Silver Institute projects a sixth consecutive annual supply deficit in 2026, approximately 67 million ounces, 6 consecutive years of demand exceeding supply. Every reserve currency in history has found its limit. The Roman denarius, the Spanish real, the British pound sterling. Each was eventually repriced against hard assets when the system's contradictions became too large to sustain. Rome debased its currency and enforced it with legions, Spain with conquistadors, Britain with the Royal Navy. All of them eventually faced the same problem. Enforcement becomes too expensive. Alternatives emerge. But the dollar's contradiction is precise and documented. You cannot run trillion-dollar annual deficits. You cannot print money without consequence. And you cannot weaponize a currency globally while expecting the world to hold it voluntarily. These three things are not compatible with each other in the long run. And Russia's survival in 2022 was the moment when the contradiction became visible to every finance ministry in the world simultaneously. By the end of 2024, the dollar's share of global foreign exchange reserves had declined to 57.3%, down from 71% in 1999. IMF COFR database, not a fringe newsletter, the International Monetary Fund. By 2025, 97% of trade within the Shanghai Cooperation Organization was settled in local currencies, not dollars. Central banks globally purchased over 1,000 tons of gold per year for 3 consecutive years, beginning in 2022. That is not coincidence, that is causation. I want to say something directly to the viewer who is 58 or 62 years old and has spent their working life inside the dollar system. You have never lived in a world where the dollar's reserve status was seriously in question. Every financial plan you have made, every asset you have accumulated, all of it was calibrated inside a world where the dollar's dominance was a fixed assumption. Russia's survival did not end that world, but it introduced the first documented, verified, structural proof that the world could change. And that proof changes what financial responsibility looks like. The gold to silver ratio currently sits at approximately 63 to 1. In 1980, during the last major petrodollar stress event, this ratio briefly touched 17 to 1. In 2011, during the Libya intervention and peak QE, it compressed to 31 to 1. At 30 to 1, with gold at its current price of approximately $4,160, silver implies $158 per ounce. That is not a prediction. That is the historical ratio applied to the current gold price. But I want to address something directly, because I know some of you are carrying an uncomfortable question. Silver hit $121 in January 2026, then pulled back 37% to $75. A 37% pullback in a structural bull market is not a refutation of the thesis. What is not corrected is the structure. And now, the accountability scorecard, every episode, all 5 metrics, no cherry picking, no goalpost moving. Metric 1, dollar's share of global forex reserves, 57.3% at end 2024. The 25-year declining trend continues, no reversal. The IMF's own measurement. Metric 2, UN oil settlement, below 5% threshold, but surrounding infrastructure accelerating. ASEAN Framework May 2025. SCO 97% in 2025. The headline number understating the structural development. Metric 3, the central bank gold purchases, above 300 tons per quarter for the 5th consecutive monitoring period. 3 consecutive annual totals above 1,000 tons. This metric has not normalized. It has not even shown meaningful deceleration. Metric 4, gold to silver ratio, approximately 63.1. The compression from 100.1 plus in April of 2025 confirmed as a trend. 37 points of compression, 148% silver delivered. The monitoring question, does compression continue? Metric 5, U.S. Treasury auction demand, bid to cover below 2.3. Signal territory. 2 metrics now simultaneously at signal level, central bank gold and Treasury auction demand. Summary, 2 metrics at signal level, 3 in monitoring territory. The structural picture continues to develop. The Russia lesson is now part of the permanent data record. Before the CTA, I want to say something directly to the viewer who has been following this series and who is sitting with a low-grade financial anxiety they cannot quite name. Well, that anxiety, the feeling that something has shifted in the financial system and you can't quite put your finger on it, is not irrational. It is pattern recognition. It is experience telling you that something in the structure has changed. This series exists because you deserve the accurate version, Not the reassuring version, not the alarming version, the structural version backed by documented data that you can verify yourself. Russia did not defeat American sanctions, but Russia survived them. And that survival, documented, measured, undeniable, is the most structurally significant thing that has happened to the global monetary system since Nixon closed the gold window in 1971. Because survival proved that the dollar's monopoly on financial access is not permanent. It proved alternatives can function. And your physical silver, outside every paper system, unreachable by any swift disconnection or reserve freeze, is the most direct expression of the same insurance those governments are purchasing. Do you think the next major sanctions target, whoever it is, will be more prepared than Russia was in February 2022? Tell me in the comments. I read every substantive answer. Your response shapes the urgency of Episode 7. Subscribe if the structural analysis is useful. Episode 7, the Saudi oil pricing architecture deep dive, is the most technically detailed episode I have built. It builds directly on the Russia survival lesson we established today. If you are a 55 or 60-year-old investor who has spent 30 minutes understanding the structural case, do one thing before the week is over. Have a specific conversation with your financial advisor about whether your allocation has accounted for the structural dollar demand erosion we have documented. Your advisor may have considered this. They may not have. Either way, the conversation will be more productive from a position of structural knowledge than from a position of vague financial anxiety. Knowledge is not panic. Knowledge is preparation. I'm the Stack Guy. Stack smart, stack physical, stay informed. The next episode drops in X days,